You're thinking about buying a home, but you don't know if you can get a mortgage. Stick around, I will break it down for you. What is up, everybody? How's it going? My name is Jesse Lynch. I'm a real estate agent in the Twin Cities of Minnesota. If you're thinking about buying a home in the Twin Cities or really anywhere in Minnesota, I would be so happy to be the person that you reach out to. I love what I do. I love real estate. I love helping people find homes. I love the nuances. I love neighborhoods, and I love construction and the way a house is built and the finishes and the paint. I love it all. So reach out to me and you won't be sorry, and I promise you won't be bugging me. And today I'm going to talk to you kind of about how do I get a mortgage. And first things first, I want to address kind of that term, get a mortgage. It's technically like an incorrect term that you're going to hear it everywhere, so you don't really have to worry about it, but just for your education. You as a home buyer, technically what you're doing is you're selling a mortgage. A mortgage is like the piece of paper. You're selling that to a lender. The lender is buying the mortgage from you with money so you can buy the home. The home is the collateral to the mortgage, and what you're really getting is a home loan. But the truth is, everybody says, even on advertisements, they say, get a mortgage for whatever. That's technically not really what it is, but nonetheless, here we are. You probably searched, can I get a mortgage or something like that, and that brought you to this video. And then second, I just want to say that I'm not a mortgage lender. I'm not a banker. I'm not a financial expert. This is not financial advice. This is just a YouTube video from a real estate agent who has some experience dealing with this kind of thing, and I'm just doing my best to kind of lay that out to you. So to get a home loan, a mortgage, there are basically three things that a lender is going to be looking for, and those three main things are job history, credit score, and debt to income ratio. So let's start with credit score. That's kind of the obvious thing that a lot of people know about. People like me and my friends, we probably know that we have bad credit scores. Mine's not that bad, but it has been terrible. So don't hesitate to reach out because you have bad credit and you're embarrassed or whatever. I assure you, I've been there. I know how it feels. Okay, so to get a home loan, basically you're going to need a minimum credit score. There's going to be a score that they won't really go under, and basically that's 580. I have heard of 560, but overwhelmingly 580 is going to be the minimum, and ideally 600 is going to be your minimum. If you're at 580 and there's no chance of you getting it up to that 600, then do 580. You might pay a little bit of a higher interest rate, but I think overall, in the grand scheme of things, it's going to be worth it, especially with interest rates being low right now. You might have to pay a slightly higher interest rate, but if you wait 6 months to bring your credit score up, then maybe interest rates are going to go up by then. You never know. Okay, and so that 580 minimum credit score, that's going to be for an FHA loan. If you've watched my other videos, you know that FHA means the Federal Housing Administration. Basically, they're an organization within the federal government, and they insure home loans, and they want more people to be able to own homes because it's a powerful thing to own your own home. It can improve your financial situation to be the owner rather than a renter. And so they want to get more people into homes. And so they'll insure home loans so that people who are maybe higher risk have a chance to get into a home. And FHA, for the record, typically offers a better interest rate if you have a lower credit score. And then sort of the other type of loan is going to be a conventional loan. Conventional loans typically are going to require a higher down payment, and they're typically also going to require a higher credit score. And typically that minimum credit score for a conventional loan is going to be 640. And if you squeak into a conventional loan with a 640 credit score, it's probably going to be a higher interest rate than if you were to be in an FHA loan with that same credit score. And now there are pros and cons to that, but that's probably a totally other video that I will do, or hit me up and ask me about it and I can help kind of walk you through it. And lastly, in regard to the credit score, if your credit score is under that, and credit is a mystical thing, right? It is a mysterious thing. Maybe you've gotten your credit report pulled a couple times for an apartment or a job or whatever, and then you get it back and it's just this weird piece of paper. Or maybe you have a credit card and it kind of gives you a rough estimate, your TransUnion credit score or whatever, and which, by the way, those are pretty accurate. So if you have one of those, they're definitely a good metric. I have 2 credit cards that both have different things like that, and they're usually very close to each other. They use different systems, but that's cool. It's a good way to measure it. You can start to sort of see how doing different things affects your credit. And I do work with some lenders who are really, really good. Basically, what they'll do is they'll take your current credit situation and they'll simulate, if you do this, if you pay off a credit card, what's it going to do to that? Or if you open up another credit card, what's it going to do to that? There's a bunch of different things in play as far as how to improve your credit. And some of the lenders that I work with are really good at taking an overlay of your credit score, your situation with your credit history and all that, and saying, okay, do X, Y, Z, and you will be at this credit score. And that's really cool. It gives you just so much clarity as far as like, well, how do I actually pull this off, right? That is huge in my opinion. And those mortgage lenders are worth their weight in gold. Okay, the next thing is job history. I'm gonna put my hair up. Sorry about that. So the next big thing that they're gonna be looking for is job history. And fundamentally, you need 2 years of job history with a relatively similar income. Obviously, it can grow. They're not going to penalize you if it is increasing over time, which theoretically for most people it will. But they want steady income, right? So they want 2 years of the same job would be the best. Also, if you had 2 years in the same company and you had a promotion, that's fine as well. And even if you have 2 years in the same industry or in the same field, they generally want to know that you have consistent income and like a solid history of employment. There are also some times where if you have 2 years of work history at one job prior and then you switch fields entirely, but you can sometimes still get a loan, but they want 6 months of pay stubs of that new job. Basically, if you've had jobs for a really long time and you have a really steady job history, but you just got a new job, you just changed fields, they want to know that, in fact, the job that you have is a solid job with steady income. Then kind of the last thing, which is pretty rare, but there are some exceptions. Say you were in school, or you were getting educated, maybe you worked for 6 months, went to school for a year, and then worked for another 6 months kind of in the same industry, and the education was just to maybe get to a better job or something like that. Sometimes there are those exceptions. I would say they're somewhat rare, but I just want you to know that they are out there. So if you find yourself in a position like that, really all you can do is reach out to a lender or two and kind of see what's up. Okay, and finally, we're at basically the last hurdle, which really is the big one and the most complicated one, and that is your debt to income ratio. And I'm going to run through sort of an example, right? Rather than just telling you you have to be at 50% debt to income ratio or less. What does that mean? I didn't know what it meant until I started doing this work, so I will do my best to lay that out for you. Feel free to take out a pen and paper if you want. You can kind of jot down your own numbers if you want. That's cool with me, and kind of start to wrap your head around it. Or you can just listen to this, write down these rough numbers, and then after this, go apply it to your own thing, and then you'll see what's up. So again, we're going to be dealing with FHA. So FHA, typically, they want a 45% debt to income ratio, but they will go up to 50%. I know that I've seen, I think actually higher than that. I think I've heard of them going up to like 55, but I think that's a really rare case, and I don't want to use that. I'm going to use 50. And so I like to kind of work this thing backwards, right? Rather than figuring out debt and then income, I like to figure out income and then debt. And so income, they're going to go off your gross monthly income when they figure out this debt to income ratio. Okay, I'm going to try to use pretty achievable numbers that aren't wildly out there, but know that if you make more or way more money than this, that you'll obviously be able to afford way more house than this, unless of course you have incredible amounts of debt. Okay, so for this example, I'm going to be using $36,000 annual income, which actually is the median household income of Minnesota by age of householder for a householder 25 years old or younger. And then as the age of householder goes up, probably kind of obvious that median income goes up. And then kind of again at 65, then it starts to dip again as well. Obviously once you're not working anymore, then your income goes down. So I want to use 36,000 because it is an attainable number. It's not some crazy number that nobody is ever going to be able to afford, or especially my peers, right? I have young friends. I want you to be able to watch this and say, okay, that is a number that I can attain. That's not such a wild number that it's just like a pipe dream for me. I want you to know, you being my peers or, just anybody watching this on YouTube or whatever, I want you to know that you too probably can afford a home. And so I'm going to use $36,000 annual income to break that down. And here's kind of how that looks. $36,000 when broken, divided by 12 months, that's $3,000 a month in monthly gross income. So we're going to start with $3,000 monthly gross income, right? And that is the income in the debt to income ratio. So then I like to take the ratio, which is the percentage that they use, which is 50%. So take that monthly income of $3,000 and apply the 50% debt to income ratio to it. And that basically leaves you with $1,500 a month. And that is kind of what your maximum debt obligation. The weird thing is that I want to say your maximum minimum debt obligations. So basically that leaves you with a sort of monthly allowance of $1,500 per month. Okay, so now we know that we have this allowance. So I'm going to put that right over here and just leave it up there, and then we're going to talk about the debts. The debt in the debt to income isn't like your total debts. It's your minimum monthly obligation to those debts. So if you have a credit card that has a balance of $4,000, but your minimum monthly payment, just to carry that debt is only $100 a month, that $100 is what they're going to be using, right? And that's going to come up on your credit score as your minimum obligation, basically, to keep that debt current or not default on that debt. So we're going to take this $100, put it up here, and we're going to talk about the rest of the debt. Say you have a car loan, right? Say it's a $300 car loan. Maybe you bought a new car a few years ago, whatever. Maybe you just bought a new car. And so with this car loan, you have a minimum debt obligation of $300. So we're going to take that $300, put it up here, and for the sake of this video, that's all I'm going to use. There's a chance that you have student loans, you have another credit card, whatever it is. Just consider all the minimum obligations that you have every month. And, maybe you don't have anything. Maybe you're watching this and you're like, who has that much of a credit card payment every month? Or like, oh God, I only buy my cars cash and I buy them cheap. Good for you, right? Good on you. You're going to be able to afford more house. That's the truth. And here is kind of why. Now we're going to take these numbers, which is basically $400. We're going to subtract it from your monthly allowance of $1,500. And that leaves you with kind of a new monthly allowance of $1,100. That $1,100 is basically what is left over for your allowance that could go towards a home loan. Okay, and maybe you're thinking, well, $1,100, that doesn't really afford much house. That's true. That's a pretty cheap house, but there definitely are houses in the Twin Cities that you can get into for $1,100 a month. It's not impossible, and I've worked with people who have done it. But maybe you're like, well, I happen to know that the neighborhood that I want to be in, the cheapest house on the block is, $300,000 or whatever, and that I'm going to need $1,500 at least to afford a house like that. Okay, I understand. So basically, then what you're going to have to do is there's three things, okay? You can make more income than that $36,000. You can have less debt obligations. So maybe you have enough money that you can just pay off that credit card, okay? Well, that only allows you $100 more a month. Or maybe you have enough money or you're really close to the end of the term of your car loan, you can pay that car loan off. That's not a bad idea. That gives you $1,300 more a month. Or just make more money. Maybe you make $48,000 a year, which is, $4,000 a month. And then that basically adds another $500 per month purchase power as far as your debt to income ratio goes. So again, if you run these numbers, right, and you do your income, you figure out all your debts, and you're left with a number that is not enough for you, and you are like, well, how can I afford more house? Again, there's basically three things you can do, and that is increase your income, lower your debt obligations, or lastly, just kind of be okay with a cheaper house for now. Maybe you can take some equity and put it into a house down the road. And also, I really want to hammer home that just because you can get qualified for something doesn't mean you should. I can't say that enough. Just because you can afford a $2,000 a month house doesn't mean you should. You got to look at yourself and go, do I want to be spending this much money every month? And if the answer is no, then don't do it. Stick to what you're comfortable with, and you'll be much better off in the long term. At the end of the day, it's super important for me as a real estate agent to get you or my friends that I've been working with. It's so important for me to get them into a house that they're comfortable affording, that they love, and that they love the neighborhood of. So I promise you, I'm not going to bullshit you about this. I'm not going to, ask you to be paying more than you're comfortable with. That is of the utmost importance to me, right? That you're going to be able to afford this house. You're not going to end up losing the house down the road because you bought something irrationally. That is very important to me, and I will not be cavalier with your money. I know money is important, and I know that it's hard to come by, and so I'm not going to spend your money frivolously, okay? I will treat your money as though it is my own, and I will treat you as though you're my best friend, which maybe you are, honestly. I've been working with so many friends lately. It's amazing. But I've also been working with some people that I don't know at all that hit me up from a YouTube video, and it's the best. I literally feel like I now have new friends, and that's what I want to be. If you're moving here from out of town, if you're buying a home for the first time and you don't know any real estate agents and that's what led you to this, I hope you enjoyed this video and I hope it was educational. Please reach out to me. I have all my information down there. Email, call, text, DM, whatever you gotta do. Just reach out to me and let's hang out. Let's be friends. Let's go look at some houses. All right. Love you. Bye-bye.